analysts have been worried about disruption from AI. Joining me, Kevin Greenback with us alongside Diane King-Hall from the New York Stock Exchange. So, Diane, firstly, as we look at today's session, it just seems like we're on repeat. Russell down, NASDAQ up, tech winning, everything else, not so much.
Yeah, you continue to see that concentration, especially in the tech sector. The NASDAQ was the leader all session long, solidified in the end. The S&P 500, though, hanging on to it. It's advanced and extending it after flip-flopping it during the session. But it seems like, in general, although it's two up, two down, as you pointed out, the bulls are looking for just kind of more fuel for the fire. They took that from Broadcom. You had the gains in NVIDIA, as you mentioned, in general. So we're just continuing to see that repeat action for the chip sector, et cetera. So especially when you think about where PPI came in today, it took off the possibility of a rate hike, and it just showed that inflation is just moving in the right direction for the expectations for the Fed.
Yeah. Kind of surprised there was no celebration today, KG. I mean, when I saw PPI hit this morning, I was like, all right, this writes itself. Here we go again. But nope, didn't work.
Yeah, I mean, you saw a little bit of a bounce there when it came to PPI, but the majority of the gains there when it came to that print were energy, and we know that that's going to be a very volatile area, and we also know that energy prices, for the most part, have started to creep up a little bit, especially when you're looking at natural gas and potentially gasoline here, especially going into the summer months. What I did find odd, though, Oliver, is going to be the breaking correlations between the dollar yields and what the equity market is doing. It's rightfully so that the small caps were going to sell off. They wanted to see cuts, this kind of based on cuts, especially when you're looking at the regionals. But looking at the sensitivity to the dollar moving to the upside, or even if yields are moving to the downside, it's not rising tides lifting all boats anymore. It's really being specific in the tech, as you kind of talked about. And for me, it kind of seems more like the safety trade until we get the next print or the next economic data points in order to provide fuel for this fire. But we've had actually a pretty decent run over the last couple of weeks.
Yeah, definitely. So, and we continue to. The grind is very real. But I've been looking for a little more action. I've been looking for like the really steamy stuff, like the melt up, like the boiling over, the insanity. When GameStop started hitting the headlines again, I thought maybe we were going that way, but apparently even Mr. Kitty himself got out of some of his positions. So I guess he's not those $100 billion swings. Maybe we're losing him some hair or something.
Yeah, I think part of it, too, is just these questions about the consumer and how strong the consumer is. So that plays into, some of the caution that we see. We'll get more insight, of course, into the consumer tomorrow when we get the preliminary consumer sentiment survey. So that gives us kind of more directions just about the state of the economy, which, like to your point, we'll see if that adds more fuel to the market, especially when it's going to be a quiet day in terms of things on the tables that could be catalyst tomorrow.
Yeah, we're going to have two fun companies this afternoon, but neither really. Maybe Adobe if it's a big win. We've also got RH coming out for a look at the higher end consumer, but Adobe clearly the highlight. The thing is, there's all this talk of the market's just so extreme in its view of AI. I get and I've been saying this since basically probably day one. I got to be honest. I think as soon as I saw the first example of any of the graphics generating AI that you could get for free, it was like, all right, Adobe's in trouble. So that part I don't disagree with, but it's also a little extreme. They're still expected to post near double-digit growth. That's kind of what they've been doing for a year. Whereas the market has rewarded a bunch of these companies on expectations that their earnings are going to start booming. It seems like it's applying the opposite to Adobe, they're going to go out of business. And I don't think that's the case. So, all right, good timing for me to kind of back off my Adobe bearishness here because now it's ramping up in the aftermarket. We did get some numbers here. They boost their forecast a little bit. Third quarter adjusted EPS 450 to 455. The estimate was for 448. And fiscal year earnings, a pretty decent little improvement there on the margin. They had said that they would max out at $18. Now they're saying they could get to $18.20. $17.60 on the low end turned into $18. That's for the fiscal year adjusted EPS. So they do raise that a little bit. I do kind of think that when in doubt on the revenue and sales side, when you have an established business line, maybe focus on a little profitability. They did also beat the estimate on the trailing revenues, $5.31 billion. Street was looking for under 5.3. So what about that profitability side, KG? Might that make sense for them to just kind of try and wring out profits from what they got?
Yeah, definitely. I mean, this has been a story that's been, this stock has been hit over the last couple of quarters here because of the challenges that they've seen with AI and then also trying to integrate it into their current product offerings right now. It's been a little bit difficult here, and they've been setting some pretty low expectations and guidance. So having this reversal in guidance, I think, is actually a tailwind for them here in the near term. And they do have a little bit of catching up to do. The stock has been fairly oversold here. I think on the conference call, though, Oliver, let's hear about their cash strategy and their cash management strategy. They have been issuing or looking at issuing some debt here in order to raise some capital, in order to potentially do some deals here in the near term. And I'm not sure if that's going to be the right or if the market really thinks that that's the right move at this point in time, as once again, we've seen this paradigm shift when it comes to their own industry in itself. But I think the bar was actually fairly low going into this print. We're seeing them exceed that. We're seeing the guidance exceeding the street's expectations pretty healthily too, right? Over $1 billion when you're looking at the guidance for fiscal year 2024. So I think this is actually a pretty decent report. The conference call, once again, can be key, though. We can see this stock pair some of these gains just based on the analyst questions and their answers to them. And we've seen that over the last couple of quarters as well.
Okay. Yeah, I mean, kind of reassuring, I think, to some extent. What do you think, Diane?
I was going to say, I mean, they needed to deliver, and it looks like they have when you look across the metrics, whether you're talking about the top or bottom line, when you break out some of their verticals, digital experience revenue at $1.33 billion, so a little better than expected. So they really needed to break out. We'll need to hear more about the monetization of AI, because that was one of the questions coming into this. When you have analysts after analysts asking about that, investors asking about that, because look, they were, kind of in the game last year. They were gaining some steam last year. They lost a lot of ground, as KG pointed out. They're down 20% year to date, so they really needed some fuel coming into this. Oppenheimer had put out a note recently coming into this, talking about the concern about the business trends that Adobe's dealing with, the headwinds there. We need to hear more on AI. That was one of the things that came up for them. Their positioning just kind of seems tenuous. They should be a leader. They hadn't been a leader so far. So seeing the numbers come out, the investors needed to see more visibility on how Adobe is doing with AI. And then they dealt with recently some of their, we know it's a platform that a lot of designers, people kind of in the arts world use, and there was some blowback about them wanting to use their content to kind of fuel their AI, their path with regard to AI. And there was blowback about that. They tried to dial that back. So there was a Business Insider report where employees, there were screenshots sent of Slack channels, employees saying, we need this content to train our AI. So, Adobe's been in a tough position, but it looks like, based on the numbers so far, without the earnings call to dive into, that they're, yes, they had this bar lowered, but they've cleared the bar.
Agreed. And I think that's important, because the bar did come down, and there's still some important negatives here. Product revenue down 20%, but they get the subscriptions coming back in. That's good. It does seem like they are getting hit for new buyers of the product suites, which I think has been well telegraphed, to Diane's point there. And the income's climbing too. Speaks to a knowledgeable kind of leadership that they know they're under some pressure here. Let's make sure that margins stay intact, et cetera. The R&D expenses up. Reached almost $1 billion, up 12% a year ago. That's one thing I do kind of wonder, Kevin, if possibly, that will kind of weigh on the trajectory if they have to spend as well to keep up, to make sure they don't fall behind. That's kind of pure narrative. I don't really know what those expenses are going towards, but it seems like that would be fairly reasonable to expect their R&D to kind of get pumped up a little bit.
Well, that's what's actually happened over the last 3 quarters, which is kind of eating into their profitability. So I think that's where the street was actually a little bit concerned about. Look, when we're talking about software, it's a little bit of a different business than the hardware side, where a lot of that spend, there's a lot of optimism that it's going to be able to see a pretty decent ROI in the near term or in the next year or 2 years. When you're looking at hardware, software, maybe not so much. Adobe was very aggressive to start off in the AI craze here, because they knew the competition was going to be pretty tough. And I think right now, I think the market's already baking that in, that they know that the expenses are going to be higher. The remaining performance obligations are also something that's notable here. They ended the quarter at 17.86 billion. So a little bit more growth there on that side. That was also a concern. Maybe they see a leveling off as people stop to and enterprises really kind of slow down the software spend, focus more on the hardware. It seems like they've already kind of gone through that kind of recessionary trend, and maybe they're going to be on the upswing here on the remaining performance obligations, which is going to be the forecasted revenue over the next 12 to 18 months. So I think that's also a good sign. But they've been spending a lot of money when it comes to R&D and trying to get these products to launch and integrate them in a easy way, to say the least, right?
Yeah, fair enough. Good stuff. All right, guys, thank you very much.